The U.S. labor market may have just delivered the warning the Federal Reserve was waiting for, and now the next inflation report could determine whether gold and silver are preparing for another major move. The latest jobs data came in much weaker than expected, with the U.S. economy losing around 23,000 jobs during July, according to the latest reports. On the surface, the unemployment rate appeared to improve slightly, but the details underneath the headline were far less encouraging. Some of that improvement came because workers left the labor force, rather than because the economy suddenly created stronger employment opportunities. And that distinction matters because the Federal Reserve does not make policy based on one headline number. It studies the entire labor market, wage growth, inflation, consumer demand, and financial conditions before deciding whether interest rates are too high or too low. Now the market is shifting its attention to the next Consumer Price Index report. Bloomberg's latest preview suggests inflationary pressures may cool somewhat, but investors are not simply looking for inflation to fall. They are looking for evidence that inflation is cooling enough to give the Federal Reserve room to become less restrictive without risking another inflation surge. That difference could be extremely important for precious metals because gold and silver do not react only to inflation itself. They react to expectations for interest rates, treasury yields, the US dollar, and investor confidence in monetary policy. If you follow macro bullion, you know we try to connect the macroeconomic story to what it actually means for gold and silver. We do not just repeat headlines. We ask what the market is likely to price next. And right now, the sequence is becoming increasingly interesting. First came the weak jobs report. That immediately raised questions about whether the economy is slowing faster than the Federal Reserve expected. Next comes CPI. If inflation also begins to cool, the Fed could suddenly find itself facing exactly the combination markets have been waiting for: weaker growth alongside easing price pressures. Historically, that combination has often been supportive for gold. When investors begin to expect easier monetary policy, treasury yields tend to fall, the US dollar can weaken, and the opportunity cost of holding gold declines. Gold does not pay interest, so when safe government bonds become less attractive on a yield basis, the relative appeal of gold often improves. Silver can participate in that move as well, although its reaction is usually more volatile because silver is influenced not only by monetary conditions, but also by expectations for industrial demand. But there is another side to this story, and that is what makes the next CPI report so important. What if inflation cools only slightly? What if core inflation remains stubborn? In that case, the Federal Reserve may acknowledge that the labor market is weakening, but still argue that it cannot move aggressively toward easier policy because inflation has not been defeated. That would likely keep treasury yields elevated and could limit the upside in gold and silver, at least in the short term. So the market is now caught between two powerful forces. The labor market is telling investors that the economy may be losing momentum. Inflation is about to tell them whether the Federal Reserve has room to respond. For gold and silver, those two pieces of information together could set the direction for the next major move. And here is the key point many investors are missing. Markets do not move simply because inflation is higher or lower. They move because the data changes expectations. If CPI comes in exactly where economists expect, the reaction may be relatively muted. But if inflation comes in meaningfully softer than expected after an already weak jobs report, investors could quickly increase their expectations for easier Fed policy. That is when the dollar, treasury yields, and precious metals could all begin moving together. So as we head into this next inflation release, the question is not simply whether prices are cooling. The real question is whether the combination of weaker employment and softer inflation is enough to change the Federal Reserve's outlook. Because if it is, gold may already be preparing for the next leg higher, while silver could be setting up for an even more volatile move if monetary expectations shift quickly. Now let's look at the part of the jobs report that may be even more important than the headline unemployment rate. The unemployment rate can improve for more than one reason. Ideally, it falls because more people are finding jobs, but it can also fall because people stop looking for work and therefore are no longer counted as unemployed. That is why the labor force participation rate and the number of people entering or leaving the workforce matter so much when we try to understand the real condition of the American economy. And this is where the latest data becomes interesting for the Federal Reserve and for precious metals investors. The recent jobs report showed a much weaker employment picture than the headline unemployment rate might initially suggest. Reports have highlighted that the labor market lost jobs in July, while the improvement in the unemployment rate was influenced by changes in labor force participation. In other words, the economy did not necessarily become stronger simply because the unemployment percentage moved in a favorable direction. That distinction is critical. Imagine an economy where companies are becoming more cautious, hiring slows down, and some workers become discouraged or stop actively searching for employment. The unemployment rate can sometimes look better even while the underlying labor market is deteriorating. That is why professional economists look beyond a single number. They examine payroll growth, participation, wage growth, hours worked, job openings, revisions, and the broader trend. For gold investors, this matters because labor market weakness can eventually change the Federal Reserve's policy calculation. The Fed has two major responsibilities: price stability and maximum employment. When inflation is high, the Fed has a reason to maintain restrictive monetary policy. But when employment conditions deteriorate, the balance begins to change. The central bank has to decide whether keeping rates high is more dangerous than allowing inflation to remain somewhat elevated. That creates the policy dilemma now facing markets. If the labor market continues weakening while inflation simultaneously moves lower, the Fed could eventually have greater justification for reducing interest rates, and markets tend to move before the Federal Reserve actually changes policy. Investors begin pricing the possibility of future rate cuts into Treasury bonds, currencies, equities, and precious metals. This is one reason gold can react strongly before an actual rate cut happens. Gold is effectively trading the expectation of future monetary conditions. If investors believe real interest rates are heading lower, the dollar is likely to weaken, and central banks will become less restrictive. Gold can move before the policy decision itself. But there is an important warning here. A weak labor market does not automatically guarantee a bullish gold environment. If inflation remains stubborn, the Fed may be trapped. Policymakers could see weaker employment but still believe that inflation is too high to justify aggressive easing. That creates a much more complicated environment. Treasury yields could remain elevated, the dollar could stay relatively firm, and gold could face periods of consolidation or profit-taking even while the longer-term macro story remains supportive. This is why the upcoming CPI report matters so much. The market already has one piece of the puzzle, weaker employment. Now it needs the second piece, inflation. If CPI confirms that price pressures are cooling, the argument for a more balanced or eventually easier Fed becomes stronger. But if CPI surprises to the upside, the market could immediately rethink the entire rate outlook. And there is another layer that matters specifically for silver. Gold is primarily driven by monetary conditions, real yields, central bank demand, geopolitical risk, and investor positioning. Silver has those monetary characteristics too, but it also has a substantial industrial component. That means a weaker economy can create a conflicting signal for silver. On one side, lower interest rates and a weaker dollar can be bullish for silver. On the other side, if the labor market weakness develops into a broader economic slowdown, investors may begin questioning industrial demand. That can limit silver's performance or make its price much more volatile. So silver needs to be watched differently from gold. Gold can benefit from economic uncertainty because investors often seek monetary protection. Silver can benefit from monetary easing, but it also needs confidence that industrial demand will remain healthy. That is why the next CPI number could have different implications for the two metals. A soft CPI combined with weak jobs could potentially create a powerful bullish setup for both metals. Gold would receive support from changing rate expectations, while silver could receive the same monetary tailwind while retaining its higher beta characteristics. But a sticky CPI combined with weak jobs would create a very different environment. The Fed could remain cautious, yields could stay elevated, and precious metals could face short-term pressure even though the economic outlook is deteriorating. And that brings us to the most important question for the market: what exactly is already priced into gold and silver? Because if traders have already positioned heavily for rate cuts, even a weak CPI report may not produce a huge upside move. The surprise has to be large enough to change expectations. That is the difference between simply reading economic data and actually analyzing markets. The number matters, but the expectation versus reality matters even more. And in part 3, we will connect that inflation question directly to Treasury yields and the US dollar, because those two markets could determine whether gold breaks higher, consolidates, or faces another short-term reversal. We will look beneath the unemployment headline, explain why the labor force data may tell a very different story than the official unemployment rate, and examine why the Federal Reserve is likely paying much closer attention to those details than many investors realize. Now we get to the part of the equation that can determine how gold and silver actually respond to the next inflation report: Treasury yields and the US dollar. Because even if inflation is cooling, precious metals do not trade in isolation. The market will immediately translate the CPI result into expectations for Federal Reserve policy, and then those expectations will show up in bond yields and the dollar. That transmission mechanism is where the next major move in gold and silver could begin. Think about the sequence this way: CPI comes in softer than expected. Traders start thinking the Federal Reserve has more room to ease monetary policy, expectations for future interest rates decline, Treasury yields can move lower, the dollar can come under pressure, and suddenly an asset like gold, which does not generate an interest payment, becomes relatively more attractive. That is the bullish chain. But the reverse is also possible. If inflation comes in hotter than expected, markets could push back expectations for aggressive easing. Treasury yields could rise, the dollar could strengthen, and gold could face immediate selling pressure. This is why simply saying lower inflation is bullish for gold is too simplistic. The real question is, how much does the CPI report change the expected path of interest rates? That is the number investors should be watching. The latest weak labor market data has already increased uncertainty around the U.S. economic outlook. That is important because the Federal Reserve cannot ignore a meaningful deterioration in employment conditions indefinitely, but policymakers also cannot declare victory over inflation simply because the jobs market is weakening. This creates a difficult balancing act. If inflation cools gradually, the Fed may be able to wait and collect more data. If inflation falls rapidly while employment continues weakening, the argument for lower rates becomes stronger. And if inflation unexpectedly accelerates again, policymakers may have to remain restrictive despite weaker growth. For gold, real yields are particularly important. Gold competes indirectly with interest-bearing assets. When inflation-adjusted yields remain attractive, investors have a stronger incentive to hold bonds and cash-generating assets. When real yields decline, the opportunity cost of holding gold becomes smaller. That is one reason the bond market can sometimes give us an early signal about where gold wants to go. But there is another important factor, the US dollar. Gold is priced globally in dollars. When the dollar strengthens, gold becomes more expensive for buyers using other currencies. That can create a headwind for demand. When the dollar weakens, the opposite can happen. And this is where the recent reaction in currency markets becomes interesting. Reuters reported that the Japanese yen surged following the weak US jobs data, while traders became increasingly alert to the possibility of currency market intervention. The broader message is that the U.S. employment report did not simply affect expectations for the Federal Reserve. It also changed global currency expectations. That matters for gold because the dollar is one of the most important variables in the precious metals equation. If weak U.S. employment data is followed by softer inflation, the dollar could face additional pressure because traders may increase expectations for easier U.S. monetary policy. That would potentially give gold another supportive macro catalyst. But again, markets rarely move in a straight line. Suppose CPI is softer, but not dramatically softer. Treasury yields fall only modestly. The dollar declines slightly. In that situation, gold might initially rise, but then struggle to sustain the move because investors had already anticipated some disinflation. Now imagine a much bigger downside surprise. Inflation comes in clearly below expectations, core inflation also cools, and the labor market is already showing signs of weakness. Suddenly, the market has a much stronger argument for future rate cuts. Treasury yields could fall sharply, the dollar could weaken, and gold could see a stronger repricing. That is the scenario precious metals investors should be watching, but silver adds another layer. Silver generally has a higher sensitivity to shifts in risk appetite and economic expectations. When liquidity conditions improve and investors become more optimistic about future growth, silver can outperform gold. But when recession fears dominate, silver can also experience much sharper volatility. So imagine a soft CPI report. If markets interpret it as inflation is cooling and the economy can avoid a recession, that could potentially be an excellent environment for silver. But if markets interpret it as inflation is cooling because economic activity is collapsing, the reaction could be very different. Gold may benefit from defensive demand, while silver could struggle with concerns about industrial consumption. This is why we should not simply call every dovish macro event bullish for silver. We need to identify why monetary conditions are becoming easier. That distinction could become especially important during the second half of the year. The market is essentially waiting for confirmation that inflation is moving lower without the economy falling into a severe downturn. If that soft landing scenario becomes more credible, gold and silver could both benefit, but silver may have more upside sensitivity because of its industrial and investment characteristics. If instead the data starts pointing towards stagflation, weak growth combined with persistent inflation, the situation becomes much more complicated. Gold could potentially remain relatively resilient because of its monetary and defensive characteristics. Silver could become more volatile because it has exposure to both monetary demand and industrial demand. So, as the CPI report approaches, I would focus on three markets simultaneously: Treasury yields, the dollar, and precious metals. Don't look at the CPI number in isolation. Watch how yields react, watch how the dollar reacts, then watch whether gold and silver confirm that move. because the market's first reaction can sometimes be misleading. The real signal is what happens after traders have had time to digest the inflation number and reprice the Federal Reserve's future policy path. And this brings us to the biggest question of all. If the next CPI report confirms that inflation is cooling while the labor market is weakening, how much upside potential is actually left in gold? And could silver finally start outperforming it? Now let's bring all of these pieces together, because the most important question for precious metals investors is not simply whether the next CPI report is going to be higher or lower. The real question is what kind of economic environment the data is confirming. If inflation is cooling at the same time that employment is weakening, the Federal Reserve could find itself moving closer to a policy pivot. But if inflation remains stubborn while the labor market deteriorates, we could be entering a much more complicated environment, one where gold and silver respond very differently. Let's start with the bullish scenario. Imagine the CPI report comes in softer than expected, core inflation also shows moderation, and the details confirm that price pressures are gradually becoming less intense. At the same time, the labor market is already showing weakness. That would create a powerful narrative for markets. Inflation is moving in the right direction while employment is losing momentum. For the Federal Reserve, that combination would matter enormously. It would provide policymakers with more flexibility. They would no longer have to focus almost exclusively on fighting inflation. They could begin giving greater weight to employment risks. Even if the Fed does not immediately cut rates, markets could begin pricing a greater probability of future easing, and markets tend to move before central banks act. That is where gold could benefit. If Treasury yields decline and the dollar weakens as investors price a more dovish Fed, gold could receive another macroeconomic tailwind. Investors who have been waiting for confirmation that monetary conditions are becoming less restrictive could begin increasing exposure. But there is an even more interesting possibility. If gold remains strong while silver starts catching up, that could indicate that the market is moving beyond defensive gold demand and beginning to price a broader precious metals cycle. Silver has historically shown a tendency to move more aggressively than gold during certain periods of precious metals strength. It has both monetary characteristics and industrial exposure. So, if investors become confident that lower rates can support economic activity rather than simply responding to recession fears, silver could potentially attract additional demand. That would create a very different market narrative. Instead of simply saying investors are buying gold because they are worried about the economy, the narrative becomes investors are buying precious metals because monetary conditions are becoming easier and economic activity may stabilize. That second environment could be particularly interesting for silver. However, we need to discuss the opposite scenario. Suppose CPI comes in hotter than expected. Suddenly, the market may begin questioning whether the Federal Reserve can ease as aggressively as investors had anticipated. Treasury yields could rise, the dollar could strengthen, and gold could experience a short-term pullback. But even here, we have to be careful. A temporary gold decline following hot CPI would not necessarily mean the longer-term bullish thesis has disappeared. It could simply mean that expectations have moved too far ahead of the actual data. This is why positioning matters. If traders are already heavily positioned for rate cuts, a disappointing CPI number could trigger a larger correction because investors would need to unwind those expectations. On the other hand, if positioning is relatively cautious, a soft CPI surprise could generate a stronger upside reaction because fewer investors are already positioned for the move. That is why I would not make an aggressive forecast based on CPI alone. I would wait for confirmation across multiple markets. If CPI is soft, yields fall, the dollar weakens, and gold breaks higher, that is a much stronger signal than CPI being soft while yields and the dollar barely respond. The same applies to silver. If silver rises alongside gold and begins outperforming, that would suggest investors are becoming more confident about the broader precious metals cycle. But if gold rises while silver struggles, the market may be signaling that investors remain defensive and are primarily seeking monetary protection. This gold versus silver relationship is something I believe investors should pay close attention to, because gold and silver are often grouped together as precious metals, but they can tell very different stories about the economy. Gold can thrive during uncertainty, monetary easing expectations, geopolitical risk, and declining real yields. Silver needs those monetary conditions, but it also benefits from industrial demand and improving economic expectations. So if the upcoming economic data creates a genuine soft landing environment, silver could potentially have more room to accelerate. But if the data starts pointing toward a hard economic slowdown, I would be much more cautious about assuming silver will automatically outperform gold. And there is another risk investors need to consider. Inflation could remain sticky even as growth slows. That is the scenario that creates the biggest headache for policymakers. If prices remain elevated while employment weakens, the Fed faces a difficult choice. Cutting rates too early could reignite inflation. Keeping rates high for too long could deepen the economic slowdown. That is essentially a stagflationary risk. Gold could remain relatively resilient in that environment because investors may seek protection against monetary uncertainty and declining confidence in economic policy. Silver, however, could experience greater two-way volatility because industrial demand concerns would become more important. So my approach here is not to predict one number and declare victory. I would build a scenario map. Soft CPI plus weak jobs equals bullish monetary setup for gold and potentially silver. Hot CPI plus weak jobs equals higher volatility and potentially stronger short-term pressure on precious metals. Soft CPI plus resilient growth equals potentially strong environment for silver. Soft CPI plus severe recession fears equals gold may have the cleaner defensive advantage. And that leads us to the final question. Where does this leave the precious metals market from here? The answer depends on whether the next wave of economic data confirms a genuine transition in monetary conditions or simply creates another temporary shift in expectations. Because if the labor market is weakening, inflation is cooling, treasury yields begin falling, and the dollar loses momentum at the same time, the macro environment could become increasingly supportive for gold. And if investors then begin believing that economic growth can stabilize under easier financial conditions, silver could potentially become the higher beta beneficiary. But before we make that call, there is one final thing we need to examine: what investors should actually watch after the CPI release, and which signals would tell us that the move in gold and silver is real rather than just another short-term market reaction. So now let's bring everything together, because the next CPI report is not just another economic release. It could become an important test of the entire US macroeconomic story. We already have evidence that the labor market is losing momentum, and now investors are waiting to see whether inflation is finally moving in the same direction. If those two trends converge, the Federal Reserve could face a very different policy environment from the one it has been dealing with. The key is not to focus on one number. Watch the relationship between employment, inflation, treasury yields, the dollar, and precious metals. If CPI comes in softer than expected and the details show genuine moderation in underlying price pressures, the first reaction could be a decline in treasury yields and a weaker dollar. If that happens while gold moves higher and holds those gains, it would suggest that investors are taking the inflation data seriously and repricing the future path of monetary policy. That would be an important confirmation signal. But if gold spikes immediately and then gives back the entire move, that tells us something very different. It could mean the market had already priced in the softer inflation reading, or that traders remain concerned about other factors such as positioning, yields, or the broader economic outlook. This is why I would not chase the first 5 or 10 minutes of market reaction. The more important signal is whether the move survives after the initial volatility. For silver, I would be watching relative performance against gold. If gold rises and silver begins rising faster, that could indicate that investors are moving from defensive monetary protection toward a broader risk-on precious metals trade. It would suggest that expectations for lower rates are being combined with confidence that industrial demand can remain relatively healthy. But if gold rises strongly while silver lags, that would tell us investors remain more focused on protection than growth. And that distinction matters. Gold can be the cleaner macro hedge when uncertainty increases. Silver tends to become more interesting when monetary conditions improve and investors become more optimistic about future economic activity. So the next phase of the market may ultimately be determined by which story wins. Is this a soft landing? Is it a hard landing? Or are we moving toward a period of slower growth combined with stubborn inflation? Each scenario creates a different environment for precious metals. In a soft landing scenario, inflation gradually cools, employment slows but remains functional, and the Federal Reserve gains room to ease policy. That could create a constructive environment for both gold and silver, with silver potentially benefiting from improving growth expectations. In a hard landing scenario, employment deteriorates much more rapidly and recession fears dominate. Gold could potentially benefit from defensive demand, expectations for aggressive monetary easing, and falling yields. Silver could remain much more volatile because industrial demand concerns would become more important. And in a stagflationary scenario, where inflation remains elevated while economic growth weakens, gold could potentially prove more resilient because monetary uncertainty becomes the dominant issue. Silver could face a much more complicated path. This is why the headline CPI number should never be viewed in isolation. The market will be looking at the details: core inflation, services inflation, housing-related inflation, goods prices, and most importantly, how the data changes expectations for Federal Reserve policy. The jobs report has already made the labor market side of the Fed's mandate more important. Now, inflation has to tell us whether policymakers have the freedom to respond. If inflation cools enough, the policy equation changes. If it doesn't, the Fed may remain cautious, and that could keep yields and the dollar elevated for longer. For gold investors, I would therefore watch Treasury yields almost as closely as the CPI number itself. If inflation cools and yields fall, that is a much stronger bullish signal than CPI cooling while yields remain stubbornly high. For silver investors, I would add another layer: economic growth expectations. If lower rates are interpreted as supportive rather than recessionary, silver could potentially gain momentum. If lower rates are interpreted as evidence that the economy is deteriorating rapidly, gold may have the cleaner setup. And this is where the macro bullion framework becomes important. We are not trying to predict one exact price. We are trying to understand the chain reaction. Jobs weaken, inflation potentially cools, Fed expectations change, Treasury yields respond, the dollar responds, gold reacts, silver reacts differently depending on growth expectations. That is the macro chain I would be watching. There is also a broader message here for investors. Markets are increasingly sensitive to changes in confidence around the U.S. economy. A weak labor market combined with cooling inflation could reinforce expectations that monetary policy eventually becomes less restrictive. But if inflation remains sticky, the Fed may have to maintain a difficult balance between supporting employment and controlling prices, and that uncertainty itself can become a driver for precious metals. Gold does not need every economic indicator to be bullish. It needs the market to believe that the monetary and economic environment is becoming more uncertain, or that the opportunity cost of holding gold is declining. Silver needs something more. It needs monetary support and enough confidence in future economic activity to keep industrial demand expectations constructive. That is why I believe the next CPI report could be more important for silver than many investors initially realize. Not because one inflation number determines the silver price, but because it could influence the entire path of rates, liquidity, the dollar, and economic expectations. So here is my base case. If inflation continues to cool while the labor market remains under pressure, the macro backdrop should become increasingly supportive for gold. Silver could follow, and if investors begin pricing a soft landing rather than a severe recession, silver has the potential to show stronger percentage moves because of its higher sensitivity to both monetary and industrial expectations. But I would not ignore the downside. A hotter-than-expected CPI report could temporarily reverse rate cut expectations, push yields higher, strengthen the dollar, and create pressure across precious metals. That is why investors should remain flexible rather than emotionally attached to one forecast. The strongest signal will come from confirmation. Soft CPI plus falling yields plus weaker dollar plus stronger gold equals bullish confirmation. If silver then starts outperforming gold, the precious metals story becomes even more interesting. And if the opposite occurs, hot CPI, rising yields, stronger dollar, and weakening metals, that would tell us the market is still not ready to fully price easier monetary policy. Ultimately, the next CPI report is not simply about inflation. It is about whether the U.S. economy is moving toward a policy environment where the Federal Reserve can finally begin responding to weakening employment without reigniting price pressures. And for gold and silver, that could be one of the most important macro questions of the coming weeks. This is exactly why I will continue watching the data, not just the headlines, because in precious metals, the biggest moves often begin before the crowd realizes the macro regime is changing. If you found this analysis useful, subscribe to Macro Bullion for independent analysis of gold, silver, the Federal Reserve, inflation, interest rates, and the global economy. And remember, this is analysis, not a guarantee of future prices. Always do your own research, DYOR, consider your own risk tolerance, and verify the latest market data before making any financial decision.